Do you have an annuity that has not earned very much because the interest rates that you got it are so low? Well, you might be able to upgrade. In this episode, we walk you through all the different things you need to think about.
To learn more about how to secure your retirement and all the different elements you need to know, please subscribe to our channel and hit the bell so you'll be notified when we release episodes every Monday. We have helped hundreds of our clients gain clarity and get on the path to a great retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement. We are happy to be able to have a conversation with you today on the podcast, and really what this is around, because a lot of folks, when they are, planning for retirement, maybe 10 years out into retirement, a lot of folks have used annuities with this idea that for a couple different reasons. One, they might use an annuity for safety, meaning they don't want market volatility on some assets, so they'll use an annuity, typically a fixed annuity. And more specifically, sometimes people will use a fixed index annuity, and they'll do it for that. They'll also do it for being able to have income possibly. And if you did one of these annuities, say 3 years ago, 4 years ago, it was in a very low interest rate environment. And then very quickly, we started seeing interest rates go up. I mean, if you go back 3 or 4 years ago, you could have an interest at a bank where you basically were making nothing on your account. And today you can go into the bank and get an account paying 4%. So the interest rate environment has changed considerably. And so the focus of this podcast is really to say, why should I reevaluate or evaluate my current annuity I have? And look at the possibilities. And a lot of times people might go, well, I can't do that. And the reason why I can't do that is that there's an early withdrawal penalty. We're going to touch on that in a little bit, not yet. But we kind of wanted to talk through ultimately what's the 4 main reasons why you should evaluate your annuity, just to make sure you are in the best place possible currently. So Marissa, you want to start us off?
Yeah. So the number one, the most important reason of why you would want to reevaluate is we've had a change in interest rates. Like Graydon said, you can get 4 or 5% on your cash in the bank today. So rates are better. In between 2022 and 2023, the Federal Reserve, they had 11 interest rate hikes in that period of time. So rates have moved. We all know that. It's all a factor of dealing with inflation. We're all very aware of that too. And so while inflation has been a negative thing as a result of some of the things that happened during the pandemic, rates have been difficult as well. But we can also take advantage of rates now that they are higher and higher than they have been in a very, very long time. And so evaluating the rate. So what does that mean inside of your annuity? When you purchase your annuity, depending on what type it was, it may have a rate for how it's going to grow its income. It may have a rate for how it's just going to grow its cash value in the sense of how it earns interest. And those rates are always moving, but just imagine where you bought it back in, say, 2015 or 2017. Banks were paying 0, mortgage rates are 3%. And so today, banks are paying 4, mortgage rates are 7 and 8%. So you can imagine that the interest crediting within the annuity has somewhat followed suit as well, to where your caps and your different strategies within the annuity are way more effective than they were back then. So I think, that we are seeing across the board very, very strong and very attractive numbers in the place where you could potentially earn 8 to 10% in a given year within the annuity structure in a safe place. And that's all off of where we sit today in the current interest rate environment. So I think it's 100% it is worth looking into if you have one. And like Graydon said, even if there is a surrender charge involved or a penalty to move away, there are things that the insurance companies do to incentivize you to take a look at your current situation.
All right. Number 2, higher inflation rates. Obviously, that's something we hear about a lot. Food costs have gone up. Other things have gone up as well. But how does that relate? Well, if you took out and you purchased an annuity with the idea that one day it's going to turn on, in all essence, what's called lifetime income that will last your lifetime, you want to have the best income possible. Well, again, this all relates back to what Merce brought up into number one, is that if, let's say, I have an annuity that's going to pay me X in 3 years or 4 years, whenever I'm going to turn on my income, and I could then kind of upgrade that to an annuity today with better interest rates, and I might make more money guaranteed for the rest of my life, would I not want it? We've had a few cases where we have been able to get individuals 20% more income than what they were going to have. So again, just think about simple terms. If I've got an annuity that's going to pay me $1,000 a month, and I could just trade it in and get one that's going to pay me $1,200, maybe $1,300 a month, why would I not want to do that? It doesn't cost me anything to move it that way, net. And so I actually end up making more income if that's what I need. And so again, I want to come back to, if you've got an annuity you've been in with this idea of I need lifetime income, you 100% want to do an evaluation, because the income rates now are significantly better than they were 3 or 4 or 5 years ago.
All right, number 3, unnecessary riders. This one is something that comes across our table every now and then. And so a rider is something that you attach to the annuity product itself. The most common rider that is attached is a guaranteed lifetime withdrawal benefit, or in a simple way, a guaranteed lifetime income stream. That's a rider. Now, when you attach a rider, there's typically one of two ways that you're going to pay for that rider. It's either you're going to pay a straight up fee within the contract, and let's just say that's 1%. That's kind of the average as far as how much these riders cost. So it's 1% that you are going to pay. You're going to see it every single year on your annual statement, and it's there. But you're buying this rider for a purpose. In this case, guaranteed lifetime income at a future point. And so that's one way. The other way could be that you're not paying a direct fee for it, but how they structure the product is that there's a reduction as far as its ability to earn interest. So the caps or the strategies may be a little bit lower because you're getting a free rider in all essence, or you're not having to pay a direct fee for it. So we can get down the path in our lives. And so maybe when you're in your early or mid 50s, you thought, I need this rider. I want to guarantee lifetime income. And you get down the road 10 years and something happens. It could be, hey, I saved way better than I ever thought I was going to. Or maybe you came into an inheritance. That's a very common one. Came into an inheritance, and now my financial plan is in fantastic space, and now I want to reevaluate and make my plan more efficient. I don't really need to pay the insurance company anymore to guarantee this income, because the assets that I have today, they're going to do it themselves if we properly manage it. So I want to reduce my overall cost and my overall exposure. And so maybe dropping an unnecessary rider is part of the reevaluation that you want to think about in your current annuity. And it's something that I've seen with clients that they bought it thinking they were going to need it. It wasn't the wrong decision to buy it, but then life happens and things change, and long-term planning happens, and we realize we just don't need it anymore, and we're still paying for it. So if it makes sense, let's get rid of it.
All right, number 4, and this is our last one on these 4 things that we want to do, life event changes. Now, this could be a lot of different things. It could be a change in marital status, employment status, significant change in assets, start date or whatever of Social Security, changing the amount of income for retirement needed, changing your health status. Any one of those life events is a good reason to say, let me do a double check here on the annuity. I'll tell you what we've seen quite a bit of is folks, maybe, now this goes back a little bit longer, but they bought an annuity, say back 8, 9, 10 years ago, and they were told, hey, you need to have this income rider. Well, because of the stock market doing well and because they are really good savers, they actually have now accumulated significant assets that puts them into a place that they don't need that, what Merce was just talking about, that unnecessary rider, because they don't need that security or that insurance about income. And so we can actually relocate the annuity and upgrade that to a position and not have the rider on there, which allows for better accumulation. So if you've had a life change event, 100%, you need to do the annuity review. I just want it to be clear. We're not saying everyone should change their annuity. We're saying everyone should review whether or not they actually want to, or whether or not they should replace their annuity.
Yeah, so part of our process in our financial plan strategy meetings is we have an update on the financial plan, right? We as advisors need to understand what your situation is, what your scenario is, what are your goals before we can make any types of recommendations. We also are going to look at and see if the investments that you have, do they fit the plan? Do they fit your goals and what you're looking for? And so let's say we get to that scenario of an unnecessary rider or a lower interest rate type of annuity. And so we start to evaluate, right? One of the, Braden said at the beginning, one of the most common things that would come up in this conversation is, well, I have surrender charges or I have fees associated with exiting my annuity. How is it possible that we're able to exit and for it to make sense? The key term there is it has to make sense for the client. That's what we're always looking at, right? So let's just say, for example, I have a $100,000 annuity. It's worth $100,000 today. That's what the cash value is. And to walk away, though, I've got this penalty, this surrender charge, and it's going to be 8% or $8,000. So if I was to say, let me just walk away and take my $8,000 hit and I walk away with $92,000 with no good reason, well, that's a bad deal. Right. But if I'm going to walk away for a specific purpose, either to drop a fee like we talked about, or to get a higher interest rate, or a combination of the two, well, now it's starting to make some sense. Add on top of that, that a lot of times today, the insurance companies want you to come over to them. And so they're incentivizing, they're creating a way for you to get out of your current annuity through, in all essence, what they call a bonus or some interest up front. So let's go back to my example. It's worth 100. To walk away, I'm going to get 92. But if I go over to this other insurance company that's providing a better rate or saving me the fee that I'm paying 1% a year of a rider, they're going to give me a 10% bonus. So my 92 that I go to with them automatically becomes 101,200. So 101,200. I had 100,000 at insurance company A. By moving to the other, I come out slightly ahead at 101,200. Now, I'll tell you, that's a nice thing. We kind of make a little bit of money in the transaction, but that is not the purpose. Ideally, we break even or we make a little bit. We're walking backwards. But now, long-term planning, we're in a better product because we're buying at the highest interest rate we've seen in a very long time.
I just want to add one little disclosure there. When we talk about a 10% bonus, obviously we're recording this as a podcast. Rates change. We've got right now some bonuses that with some companies that are higher than that, some that are lower than that. The point here is that do the numbers make sense so that I'm not going negative? And if I can move from one place to the other, we're just giving you a hypothetical about what we are seeing right now. And that's the key point. Yeah. So for example, right now we see a lot of folks that have caps on their what they can earn. A very common cap, if you bought something 3 or 4 years ago, is a 2 or 3% cap. Today, you can get a cap, moving it in that example that Merce just talked about with the 10% bonus type scenario, and you could have caps around 8%. So think about it. I moved, it didn't cost me anything at the end of the day, and I'm able to now have a little bit better earning potential. So that's the concept. That's the concept in this picture. So really, if you're listening to this and you think, man, I do have an annuity, I would like to have a review done on it. How do you do it? Well, you can talk to whoever you want to talk to that maybe helps you on that. We do that. So if you wanted to talk to us, for example, you can go to our website, top right-hand corner, click on schedule call. We'll hop on the call, ask a couple questions, tell you exactly how to walk through getting that reviewed. But this is a step that we would strongly encourage you to at least look at if you already have an annuity, because it is a good time to upgrade, and we don't know how long interest rates are going to stay where they are right now. Hope this has been helpful, though, and we will talk to you again next Monday.
We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step-by-step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.